In an industry where a company that's a long-term investment is hard to find, there is one gold company that may pique your interest for gold investing, and that is Sandstorm Gold. Sandstorm Gold is a royalty and streaming company that provides capital to gold mining companies in exchange for a cut of the gold that they dig out of the mine. And Sandstorm buys that gold at a low fixed price, typically around $400 per ounce on average. There are a few gold royalty companies out there, but we think Sandstorm is worthy of your own due diligence. As a disclosure, we are proud shareholders of the company, and although we hardly advertise gold stocks, we believe in the Sandstorm management, led by former executive of Silver Wheaton, Nolan Watson. Sandstorm Gold is geographically diversified, with exposure in North and South America, Africa, and Asia, and also has 21 producing assets that have netted them an increasing amount of positive operating cash flow and revenue in the past 4 quarters. They also have 22 mines in the development stage that will increase their cash flow substantially in the next few years. Be sure to check out Sandstorm Gold at sandstormgold.com/invest. Hi everyone, this is Jason Bjork of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He worked on Wall Street for many years as a bond trader. He's also a gold hedge fund manager, and he writes a short seller's journal and a gold stock investment newsletter for juniors on investment research dynamics, and he's also co-host with Rory Hall of Shadow of Truth, which is a podcast I enjoy listening to on YouTube. Dave Kranzler, thank you for joining me again.
Thanks for having me, Jason. It's good to be on your show again.
Thank you, Dave. I'm glad to talk about the gold market, and the gold market's been responding well in 2017, similar to 2016. The Federal Reserve, Janet Yellen, and the other basically automatons there have been hinting at raising interest rates in March, and the Federal Reserve is predicting that they will make 3 interest rate increases in 2017. What do you think is the probability that they do raise interest rates in March and also 3 interest rate increases in 2017?
Well, they might, just for appearance sake, raise interest rates again one more time in 2017. Because their credibility is at stake. But I mean, it's debatable whether or not you can even call a quarter-point hike an interest rate hike. It doesn't, I mean, it's what kills me about this market is that, Wall Street and investors stand in fear of a whopping 25 basis point interest rate hike, and I mean, it's minuscule. I mean, to just, everyone talks about rate normalization or normalization of monetary policy. Well, I don't even know what that means anymore because the Fed has been manipulating interest rates for so long. If you wanted to look at where interest rates were before the 2008 financial crisis, which I believe was a de facto financial collapse, we had short-term rates were running, around 5%. So think how many quarter-point hikes it would take to get back to 5% if that's what normal rates are. No one can tell you what normalized rates are, so to even have the discussion about it is silly. But having said that, I think they threatened us with 4 quarter-point interest rate hikes in 2016, and they had one at the last month of the year. Was their last chance to at least fulfill 25% of their promise. And I guess they've promised us or threatened us with 4 this year. So, presumably we should expect 3 more hikes. I don't think we'll see those. Like I said, I think there's a chance we might see 1 more. I don't think it's coming in March. And I haven't studied the minutes from the last meeting that were released today, but I saw some headlines, and it sounded like, based on the tenor of the headlines I saw, that the Fed is already wavering on whether or not to hike rates in March. And, I think that interpretation is correct because gold was down in the futures market about $9 before the minutes were released. And it actually closed, it's actually before the access, the access market's still trading right now, the Globex market, and it's actually positive on the day from where it closed yesterday at 5 p.m. Eastern time. So it retraced that $9 hit as soon as the minutes were released. So that tells me that it's likely we won't see a rate hike in March, even though you've got a couple of these yo-yos out here from the Fed who are threatening us with it.
The Dow has had record closes high. We're over 20,000 Dow. The last time the Dow had this many record high closes was in 1987, and we know what happened in 1987.
Yes, I think the stock market crashed, I want to say 24%. It was over 20%. And I remember it vividly because I had just taken a job. I was a two-year analyst in the two-year analyst program at Goldman Sachs right after college. And instead of going to business school, I found a good job with a small LBO boutique firm. And I had just taken that job, and the stock market it crashed my first week there, and I was like, oh no, I wonder how long I'll have this job for. And then Greenspan stepped in and saved the market and pushed it up again, and then it had a crash again in 1989, and that was kind of coincided with the collapse at Drexel. So I don't really, I mean, I guess you could probably I don't think you can compare what we have right now with 1987, because back in that time, you still had a relatively low level of federal debt as a percentage of GDP, and you had a much higher percentage of the civilian-aged working population actually working. I mean, there's a lot of variables. Balance of payments were probably, and again, I'd have to look it up, but if they weren't still positive at that point, they had just gone negative. And the valuations in 87 they're not even much lower than they are now. The current stock market, I think, if you could use the same type of GAAP accounting standards that were used in 1999, or I don't even know if they were used in 1929, but if you could have an apples to apples comparison of earnings using the identical accounting methodologies, I do think that this current stock market would prove to be the most overvalued in history.
That is a very interesting statement you just made. Yeah, when I look at the stock market valuations now, I see utility stocks with really no revenue growth selling for 23 times earnings. Forward earnings are even larger. I see record amounts of share buybacks, although the share buybacks are slowing. That happens with cheap debt, and also, with the corporate governance here in the United States, the incentive structure that's been set in place by, board of directors for companies is really stupid. It incentivizes the management teams to focus on myopia and short-term earnings, and they play the earnings beat game instead of making, sound long-term investments in the companies. The other thing you mentioned is how you started in leverage buyouts. I mean, because of cheap debt, Dave, we've had record amounts of leveraged buyouts really since the 2009 reflation, and central banks stepping back in and banks getting the accounting rules changed. We've had record amounts of leveraged buyouts pick up, and that's one way that the lack of revenue has been made up. But the valuations in the stock market are pretty mind-boggling. I don't think there's really any fundamental reason for why the stock market is going higher. I think a lot of it is, hopium. I think there was a big short squeeze on. There was a lot of people before the election results were in that were thinking if Trump had won, the stock market could crash. Even when Trump won, they were thinking that the stock market could still crash, and then it didn't. So there was a big short covering rally with that short squeeze. So even George Soros was caught off guard, and normally, given his political connections and how much of a crony and insider he is, he doesn't get caught, on the wrong side of trade too many times. So you add those things in with the hopium and the valuations and how much extra money the central banks have been putting in with the trillions, and you have these just real sky-high valuations. I think the S&P 500, Dave, total when you add up the value of all the S&P 500 companies, we're at $20 trillion now. So we have about 20 trillion debt, 20 trillion valuation on the S&P 500, 20,000 Dow. Welcome to dystopia.
That's true. With respect to Soros, and believe me, I am no Soros fan. In fact, I'm probably an anti-fan of George Soros, but it's not clear that he's on the wrong side of the trade yet. If you want to measure it over a short-term basis, yeah, he's underwater on his shorts, but I suppose maybe he's in it for a longer term, because I really think when this market goes, it's going to seriously flush. I mean, it's going to cause irreparable systemic damage, and the only way that they'd be able to save it would be to go into the type of hyper currency printing that we saw in Weimar Germany or Zimbabwe.
Yeah, I mean, based on my sources, Dave, I mean, they basically already done that since the 2008 crash. They put tens of trillions of dollars into the system. We know that from Freedom of Information Acts that were released, how much the European Central Bank was given by the Federal Reserve in currency swaps, over $10 trillion during the 2008 financial crisis and afterward, to delay, collapse of Deutsche Bank and other European banks. We also know that from Ron Paul's one-time partial audit of the Federal Reserve, which, all these scumbags in Congress are fighting another audit of the Federal Reserve now. Even Bernie Sanders, who supposedly hates the banks, right? He's fighting the next audit of the Federal Reserve that Rand Paul and Senator Thomas Massie want. So it's very frustrating. I would love to see an independent audit of the Fed. I've heard some people say that the Fed is honest with their balance sheet, but that may just be some of the treasuries. We know that there's hypothecation of the treasuries. I've heard from my contacts, Dave, that these things are the treasuries. There's people using them as collateral, and they're the treasuries. At one point during the height of the 2008 crisis, there was 4-to-1 of hypothecation of treasuries. I think it's down to 2-to-1 now with the leverage in the system of treasuries as collateral.
Oh, I have no doubt it's higher than 2-to-1. I think hypothecation of treasury is probably more like 10-to-1. It's one of those things that's impossible to prove, but that's just where I think it is.
Yeah, so I think they've already basically, to a certain extent, hyperinflated and created a crack-up boom in some of the asset prices because, from the numbers from Jim Rickers and the other things I said, they've put tens of trillions of dollars into the asset markets, and that's kept up the general stock market, the bond market, a lot of real estate to a certain extent. Now, obviously, we have inflation in the real economy, but, we haven't had this runaway inflation in the real economy yet. So I obviously, like with my healthcare bills are up a lot. I'm seeing like consumer prices, some of the consumer items, like I took a picture of this and put it on the Wall Street for Main Street Facebook group. I was going and buying, face cream the other day at Target, and I was devalued by 26%. So the price stayed the same on my Clearasil. It was like $7 for 6.78 ounces of Clearasil cream, right? Now they've kept the price the same, and I get 5 ounces. So, and the government statistics don't reflect this. So I know I think there's been less inflation in the real economy than there has been in the asset markets. They've been able to direct the blast of the monetary inflation and credit into the asset markets, and that's, kept hyperinflation and runaway stagflation so far. But do you think Trump, now that Trump has won, do you think he's going to be able to stop or turn the tides meaningfully in any way, or do you think some of his policies could potentially make things even worse?
That's a good question. I don't know if anyone can answer that question. I don't even know if Trump can answer that question. With Trump, I'm not really sure what we're going to see, what he's going to propose, what he's going to retract, and if he does start putting legislation on the floor of Congress, what's going to get passed. So I think, this is the craziest presidency I've ever seen, and I just think it's obvious. Everyone's talking about it now, so it's not like any kind of new news, but there's really political chaos going on in D.C. and whether or not Trump can pull it all together and fix the situation remains to be seen. But I can't really comment on what Trump's policies will or won't do to the system, because I don't really know, what he's ultimately going to try and get through Congress.
It looks to me like he wants to be Ronald Reagan, do the supply side economic stimulus. But I've seen some hedge fund managers that are very smart. They're not libertarian, but they're, capitalists. And they think historically he's going to more end up like Herbert Hoover.
Yeah, I think that's kind of a common line of thinking. I mean, what Reagan did, you can't do now because it was it was just like 1987. It's a completely different economic environment. The U.S. still had a positive trade balance. It had a positive balance of payments. On a relative scale, it had very little government debt. Interest rates were, Volcker took them up to 21% temporarily. So, Reagan had the benefit of a secular interest rate decline cycle that bottomed out when the Fed basically took them down to zero in, I guess, probably 2009 is when they got them all the way down to zero. Maybe they got them down there. I forget when they actually hit the 0 to quarter basis point Fed funds range. But Reagan's programs weren't necessarily this supply side, cut taxes, stimulate the economy. It was accompanied by a massive buildup in defense spending. So it was tax cuts accompanied by massive government spending. And Trump has proposed, this wall and the infrastructure rebuild. Well, that's massive government spending, but then the issue is how do you pay for it? And I don't think you could even pay for it.
I see really bad stagflation coming, Dave, in a number of different ways. So if Trump is successful with some of his infrastructure defense spending programs, I think that could get, there could be some wage growth, or people who have more confidence, businessmen, small, medium-sized business owners in the U.S. could make investments and property, plant, and equipment, and that could pick up the velocity of money in the real economy going again. So that would be stagflationary, I think. And if Trump isn't successful, with those tax cuts combined with the increase in spending, I could see people start to worry about the debt, and I could see that creating stagflation as well.
Yeah, absolutely. Again, it's hard to say. I mean, the economy, if the Fed stepped away for even a day, the economy would collapse. The whole system would collapse. So, it's the system's broken. It needs to be. Everything needs to be burned down to the ground and rebuilt, starting with everything the government does. But that's not going to happen. And so ultimately what Trump's going to do is he's, to the extent that he gets any of his programs into Congress and through Congress, it's just going to layer on more poison on top of the poison that's already there.
Now, Trump recently also put, I don't know if you saw his press conference or listened to his press conference last week on Thursday. He just went on this huge tirade about the mainstream media and how they're fake news. He singled out CNN. He said he inherited an enormous mess in many different ways. He talked about his two main objectives were to fix the economy, create jobs, and then also repeal Obamacare, and those were his main priorities. And then he sent out a tweet a day or two later talking about how the mainstream media is the enemy of the American people. Do you agree with him on that statement?
Yeah, I think he did inherit a mess, but I don't think that anything he's proposed is going to fix it. I mean, Obama inherited a mess from Bush, and Bush inherited a mess from Clinton, and so on. I mean, and the further away we get from Nixon closing the gold window, the worse the mess becomes. Oh, yeah. And to me, the most interesting statement that's been made by anyone, maybe in my lifetime, was when Greenspan did that interview with the World Gold Council, whatever their magazine is called. Have you seen it?
I saw it on your website. I did not see it on their own source. So I saw you and Rory talking about it in your podcast for Shadow of Truth. But it's very interesting. I mean, Greenspan, we know he knew better. That's why I consider him, a Benedict Arnold, because he was at one point, an Ayn Rand libertarian. That essay he wrote on golden economic freedom is one of the best pieces of writing about, a welfare state and what central banks can do to destroy, purchasing power of currency, and yet here he is, he totally sold out.
Well, he's got an interesting life cycle. He came full circle. Obviously, he was a gold standard proponent in 1966 when he wrote that essay, and he's come full. Then he was, Mr. Fiat Currency Money Maestro, and in front of Congress, he stated, a disciplined central bank can stand in place of a gold standard and support the fiat currency system. Well, now he's come full circle. I actually went to the source, and you can go to the World Gold Council website and pull up the publication for free. And he said, if the gold standard were in place today, we would not have reached the situation in which we now find ourselves. We cannot afford to spend on infrastructure in the way that we should. The U.S. sorely needs it, and it would pay for itself eventually in the form of a better economic environment. But few of such benefits would be reflected in private cash flow to repay debt. Much of the infrastructure would have to be funded with government debt. We are already in danger of seeing the ratio of federal debt to GDP edging toward triple digits. Well, it's already well over triple digits. But we would never have reached this position of extreme indebtedness were we on the gold standard, because the gold standard is a way of ensuring that fiscal policy never gets out of line. And that's it right there in a nutshell. That's basically, that's a paraphrase of golden economic freedom. So I think what he's doing is probably like all the other guys who leave the Fed. They understand what a mess everything is, and now he's out there trying to save his legacy as an economist.
According to my sources too, Dave, I spoke to Pippa Malmgren about this over the summer. Not sure if you listened to that interview, but she's connected. She worked on the plunge protection team for a little bit. One of the ones, that wasn't doing all the trading, just the academic plunge protection team at one point. And she said basically her contacts at the Federal Reserve, not the ones at the top like Janet Yellen or the other religious ones who believe in their Keynesian economics, but the lower ones in the basement who run the economic models. And they said that their economic models are broken and not tracking reality, anything close to reality at all. So we are starting to get a little bit more honesty out of some of the people, whether they leave the central banks or lower level people at Federal Reserve. I know Danielle DiMartino has a new book that's out now called Fed Up. And she was, one of the economic advisors to Richard Fisher at the Dallas Fed. I think Fisher was the only Federal Reserve Board of Governor that voted against the QE programs. So, and he was also the only one who had Wall Street and finance background, who had actually worked in the real world and was in a PhD ivory tower economist.
Interesting.
Yeah, so I think Alan Greenspan's a really smart guy, but he's been talking about the infrastructure problems in the United States for a long time. I think I can't remember if it was your website where you pulled up an older speech, but Alan Greenspan was manipulating the gold price for a long time with the gold leases and the gold swaps. We have another economic mine now, Dave, is this infrastructure. The Oroville Dam highlighted it. I listened to, I don't know if you caught this, but Chris Martinson interviewed a infrastructure and dam repair expert last week on his podcast because he was covering the story, and the guy basically said California could have 5-10 years ago fixed this problem for $5 or $6 million bucks, fixing this part of the area to get the water out on the side escapes, and they didn't. They just neglected it. Now it's going to be over $200 million problem, and that's if the dam doesn't crack. And supposedly this dam wasn't even on the list of multi-billion-dollar infrastructure projects that the state of California said were in dire need. So I think there's going to be a $200 trillion, not $200 trillion. There's going to be over a $2 trillion economic landmine in the U.S. for the infrastructure projects, and that's on top of all the other economic landmines.
That's, again, it underscores the point I was making earlier about, Trump inherited a mess, and it's a mess that keeps snowballing because no president tries to fix it. So I really don't think Trump's going to buck that trend.
Yeah, and I thought Obama had what, 800 billion in shovel-ready infrastructure projects. I don't remember any of them, any significant ones ever being built. So I remember
Well,
that was.
it was all wherever you go in the country, there's all this road work being done, and they keep repaving the same roads here in Denver, and it's basically, the government's issuing debt and using some of that money to keep people employed paving roads and filling potholes.
And roads are like the least amount of danger that for some of the infrastructure. We have dams, we have airports, we have bridges that are in dire need of. We have nuclear power plants that were only supposed to run for 30 or 40 years. These old light water pressurized nuclear power plant reactors. And these things were only constructed to run for 30 or 40 years, and now some of them are running for 60 or 70 years. So that worries me too.
You can fix that problem. All you need to do is put a usage toll on all of this infrastructure so that everyone who uses it pays for it, and then you can issue debt against the revenues from the usage fees. You don't have to have the federal government involved in it in any way, shape, or form other than mandating that it's to happen. And that's how you pay for the infrastructure fixes.
I would be in favor of a free market solution. So if people are going to pay 1 cent a day or something, or 1 cent per which way they use the road, that would be okay. But we're going to have all these Democrats screaming that poor people can't afford it. Rich people would only be able to afford it, and then they would scream at who would build the roads, because that's like always the Democrats' response. For when we talk about, free market or competition or privatizing these infrastructure projects.
If you can afford a car, you can afford a 50-cent toll every time you use a bridge that is in need of repair.
Dave, you should come to Northern Virginia. You should come to the Military Information Complex and rest in about 35-40 minutes away. There is a toll road there. People do take it. They only take the short part, cheaper part of the toll road. They would rather wait about 50 minutes or an hour getting off at Sully Road there to get to Ashburn and get stuck in a parking lot rather than pay an extra $5 or $10 a day for an extra toll to have no wait at all on the other part of the toll road.
If they made everyone use the toll road, they wouldn't have to charge $5 a day.
I don't know. It's been privatized, Dave. So I don't know. I think most people, they're so tight on their budgets with their discretionary income, or their wives or whatever would nag at them for spending the extra money, that they're not doing it. So I went on a date out to Ashburn. I don't want to talk about this any more than that, because I'm not seeing this girl anymore. But I use this alternate route, and I save myself like an hour in traffic by going this one way, paying an extra $10 on the toll road there. There was almost no cars there, and the other way was a parking lot, because everyone was trying to save $5 or $10 on the toll. So it's just funny that people will do stuff like that to save a couple dollars here or there, and then get a headache and have to sit in a parking lot traffic. Okay, well, I want to transition to I don't want to talk about my dating life anymore. I want to transition now, talk about the gold market. So last time we had you on, the Deutsche Bank stuff had been being teased. We didn't have the settlement numbers yet. We knew that they were going to settle pretty quickly. I think they settled for $98 million for their London gold fix, London silver fix total when you combine them. Meanwhile, they made many billions in profits. The gold price really hasn't gone up a lot, despite Deutsche Bank admitting that the gold conspiracy theory is a fact with all these documents. Why do you think the gold price is not going up nearly as much when we have all this evidence now of the manipulation?
I mean, because everyone who's involved in the gold market already knows about the intervention and the manipulation. It's not any new news. I don't need a court to put the stamp of approval on something that I already know has been going on for well longer than the 16 years I've been studying and researching and investing and trading the precious metals market. So it's not like these court cases are splitting the atom in terms of what's really going on. So I think that if you step back and you look at the price of gold from the beginning of 2001 until now, gold has been the best performing asset class. I think there's a couple, oddball type commodities that may have performed better. But I mean, the stock market has maybe doubled in that period of time. The price of gold's gone up 400%. So, how much higher the price of gold would be without the manipulation, I mean, that's open for debate. I don't really know. I don't think anyone can I don't think you can really mathematically estimate it or reasonably throw economic models at it and estimate where the price of gold would be. All we can say is that it would be many multiples higher than where it is now. I mean, you can use some benchmarks like, the ratio of federal debt outstanding to gold, to the price of gold, that type of thing. You could say, well, in 1981, the Dow gold ratio was 1-to-1, and over many centuries, the Dow, or not, not, I guess for this country it wouldn't be many centuries, but over 300 years that the Dow's been around, or however long it's been, the stock market there, it's the Dow gold ratio has occasionally touched 1-to-1. It did it again in, I believe, 1999 or 1929. So if you wanted to say, okay, the Dow gold ratio right now is probably about 15-to-1, whatever that number is. It's roughly calculated here for you right now.
Oh, I would add to your points there that
it's 17-to-1. So you could say, okay, gold may be undervalued by a factor of 17. So I think people kind of get too enamored with the manipulation story, and rather than focus on looking at the factors that are going to, and let's just say the manipulation is going to be there until the paper market fails. What are the factors that are going to drive gold higher? And they just keep getting stronger every day. And I think right now, the price of gold, I think they're having trouble keeping it down, because I think there's enormous pressure from the Eastern physical markets, like we were talking about before we started doing the podcast. The demand in China is much greater than what's being publicly published. And the same thing holds true with India. I mean, they can't quantify the amount of gold being smuggled into India, but it's in the hundreds of tons. So I think right now, I think there's stress coming from underneath the paper market, from the physical market, because you've got markets where they demand physical delivery of gold, unlike the COMEX or the LBMA or the GLD Gold Trust. I mean, who knows what's really in that trust, if you want to talk about, hypothecation of assets. So, I guess that's sort of a long way of saying why I don't think the Deutsche Bank lawsuit has really affected the price of gold and silver.
Yeah, I would like to see some of the primary gold and silver miners also file class action lawsuits now that the evidence has come out, and go after and try to reclaim damages for their shareholders too as well. But I'm not sure if any of the primary gold and silver miners outside of maybe Keith Neumeyer, First Majestic Silver, are interested in it, frankly. A lot of the management teams are too scared to touch that subject.
Yeah, I agree with that. We'll never see that.
But one of the other points for why gold should be higher is, what a dollar was worth purchasing power-wise in 1980. So gold's, inflation adjusted using government numbers, 1980 high, it would be $2,700, right? And silver would be a lot higher than 50. So gold and silver are not making, even when silver the silver still hasn't gone anywhere near its inflation adjusted high. And gold was, even when it got to 1900 in 2011, before the bear market started, gold was nowhere near its inflation adjusted high as well, considering how much the dollar has been devalued. So I think,
oh yeah, no question about that.
So I think that should be, a starting point for where gold and silver will end up before this bull market is over. I think we're going to see, way above inflation adjusted silver would be a well over $100, and gold well over $2,700.
Yeah, I don't think that's your starting point. I think your starting point might be put the Bretton Woods rule to the test, the Bretton Woods Agreement, which is that the U.S. has to back the amount of treasuries issued to foreigners with gold, and it has to be redeemable. Those treasuries have to be redeemable in gold. So that means the value of the gold that's theoretically held in Fort Knox, and let's just assume it is, the value of the gold that's held in Fort Knox, which I think they price it at what, $42 an ounce or something like that?
Yeah, it's a ridiculous number.
Yeah, so you'd have to reset the price of gold so that the value of the gold in Fort Knox would back the amount of debt issued to foreigners. And the last time I looked, I think that number is around $5 or $6 trillion. So
yeah, I don't think they're going to do that voluntarily, Dave.
No, of course not. Of course not. They'll go to war before they have to do that.
Well, we've I don't know if you've heard this, but I've heard that the Chinese have talked about in the next 5 to 10 years as putting gold representation in the SDR basket. So that wouldn't obviously force the U.S. onto a strict gold standard or gold-backed bonds, like you said, but that would be like some type of vehicle there to put gold in a basket of currencies. But then that would allow them more liquidity injections with the SDR with the next crisis, to start printing many trillions more in SDR bonds to reflate the system again and keep most of the status quo going. Basically what they're doing now behind the scenes with currency swaps.
Yeah, I don't know what's going to happen with the SDR and what China's intentions are with gold. We just know that they're accumulating a heck of a lot of it.
Yeah, I don't think China has any intention of having a gold-backed currency, at least not anytime soon, because, they're devaluing their own currency right now, and they're pissing off a lot of their own citizens. That's why so much Bitcoin demand is in China, and Chinese private citizens are buying a lot of gold and silver as well. So I don't think the Chinese government's going to do that. They're not gonna back their own currency with gold, but they are accumulating gold for asset purposes, for diversification purposes, because they've accumulated way too many U.S. treasuries.
I don't know what China's going to end up doing with its gold. I just know that in terms of a gold-backed currency, but I just know they're accumulating a heck of a lot of it, and they got to be doing it for a reason.
I think they want to be the world reserve currency at some point. So in order to get on the they weren't supposed to get into the SDR basket and get a partial reserve backing. Get on there. They weren't supposed to. They didn't meet all the requirements, but they got on there politically because they have so much pull in world trade now. So they were able to accelerate that, and I think they figured out one of the main reasons the U.S. got the sole world reserve currency was because they had so many gold reserves. So I think that's why they're accumulating so much gold. Is they're heading down the path the U.S. did prior to World War II.
Right. No question about that.
Well, I want to ask you now about the gold and silver mining industry. So in 2016, we had a bull market restart, I guess. It started late 2015, and for part of 2016, some of the juniors were able to raise capital. Some of my listeners subscribe to your newsletter, and they've told me that they've made some fantastic gains on some of your junior mining stocks. You've picked out winners where there's been hundreds of % return in only a couple months. How do you research some of these juniors to separate the wheat from the chaff? Because there's so many juniors, the mining stocks of the juniors may go up, but the company's extremely poorly run. They're paying some guy on YouTube thousands of dollars to pump the shit out of the stock, or they're they don't have anyone on the management team with any geology background or anyone with a financial background. They're paying lots of money for marketing, and yet the company is just a facade. So how do you separate those companies from quality companies in the junior space?
Well, I take a big list of junior mining stock ideas, and I tack it to the wall and throw a few darts at it. And those are the stocks I write about. No, I'm just kidding. I'm just kidding.
I was gonna say, Dave, that you'd probably get better odds in Vegas then, or Macau.
I'm just kidding. No, I mean, the stocks that you referenced, both of those, or a couple of the ideas, I've had, more than two that had some pretty phenomenal returns, and part of it's luck, part of it's the luck of timing. Two of the stocks, Almadex and Silvercrest Metals, I was aware of those situations from my previous knowledge of sort of their predecessor stocks, Almaden Minerals and Silvercrest Mines, and I knew that I knew the properties that were spun out into those two stocks, Almadex and Silvercrest Metals. And as soon as the stocks became public issues, I got to work on them, and both companies started releasing really strong drilling results, and it happened at a time, when the market was in a big upswing. So it was partially a function of my background knowledge of the companies, and having the benefit of a strong market. So and there's actually a couple stocks that I published on while the market was going down between August and December that had sort of fundamental news events that caused the stocks to do really well. So that's part of it. And the other part of it is just, over 16 years of researching the sector and studying these stocks, I've just kind of come up with some general guidelines that I try to adhere to, and a lot of it has to do with just sort of the basics that probably everyone kind of knows about by now, which you want to invest in juniors that have properties that are in areas that have a historical pedigree of producing big deposits. So for instance, the Carlin Trend in Nevada, that's an easy one. So I look for juniors that are poking holes in areas where there's been previous success in those areas. I also look at the background of management, and in general, I don't like to invest in juniors that are being run by financial operators, even if they do have good geologists on their team. I think either the CEO or the chief operating officer and the head of exploration at the company needs to be a geologist, because it's a lot easier to bone up on finance than it is to learn geology, right? Another aspect of it is assessing the political risk of where the property is, and one of the misconceptions that people have is that the U.S. is necessarily one of the more politically friendly jurisdictions. And if you talk to mining company executives who are developing properties, they'll tell you no, that's not true, because especially with regard to environmental roadblocks, the U.S. is actually politically unfriendly. And contrary to what might be the popular delusion out there, some of the places that you might think are difficult places to develop mines are actually friendlier and easier to develop a mine than the U.S., Russia being one of them. Another one that's it's a tough jurisdiction, but in terms of just general support from the government and trying to get people to develop mines there, is the Congo. I don't even forget what they call it now.
The Democratic Republic of Congo. I actually made 500 or 600% off Lundin Mining. I bought it during the 2008 collapse, and Lucas Lundin, the Lundin family's billionaire resource investor.
Right.
So that project was coming online. It looked like bankruptcy was a possibility, but the mine was close to coming online. And then, I saw the China stimulus program. I saw, the Federal Reserve announcing a stimulus. I figured that would benefit, and I figured the Lundin family would back that mining company. So it went from like 30 cents to $5 within 18 months.
Yeah,
so,
Lundin is one that I used to shy away from because I was worried about the political risk in the Congo. But
well, yeah, I'm not a long-term investor in that. I took my gains and got out a while ago.
Well, yeah,
but
you got to do that, and it doesn't matter what the story is. You make 5 times your money. Thank you. See you later. On to the next. So another factor, so I've got, where the property location, jurisdiction, strength of management. I like to see juniors that have, funded for at least a year and preferably longer, because we go through periods where it's tough to raise capital. I ideally, although it's not a requirement, I'd like to see a strategic investor that owns, at least 10% of the stock. And a lot of the ideas that I look at, that's the case. I also like to see management have at least 10% of the stock, if not more. I think in these companies, juniors are basically venture capital plays. And so you want to have a company where management has its own skin in the game, and not stock that comes from stock awards. It's stock that comes from actually putting money up front to get the company started. And so that's sort of the basic gist of it. I mean, there's some other things that go into it, but that's kind of my basic guideline right there and that's just to get started. And then there's a whole other, host of issues that you need to look at when you're analyzing these companies. So
is infrastructure important to you? Because obviously there's examples of large mines that can be built, but it has to be a really big potential mine, or it has to be very high grade plus a large potential mine. Like obviously Pretium is it's an enormous mine and it's getting built, but it's not really near any infrastructure. But they needed a lot of capex. But the average junior can't afford that unless either they sell the company or they do like a JV partnership deal, like what Mag Silver had to do with Fresnillo in Mexico. So is infrastructure a big deal to you for the where they're drilling to be near infrastructure?
Oh yeah, absolutely. Infrastructure is important. That includes source of power, quality and availability of roads and other sources of transportation, water, labor, and that's just part of it. So yeah, infrastructure is very important.
Yeah, because there's some, monster gold deposits in British Columbia, up there in the Yukon or in Alaska, but the capex on these things, are many billions. You look at how much money Barrick Gold had to sink into Pascua-Lama. I think there are over $10 billion in capex, and the mine's not near production. So that's, one of the cautionary tales of the mining industry and what could go wrong. But we see this now. I know you don't cover a lot of the big companies, but I do these videos for my listeners so they won't go out and buy lots of regular mining companies. I prefer the royalty and streaming companies because their costs are fixed, they're more diversified, and they can't go bankrupt if one deal goes bad. But you have situations with these, primary gold and silver miners. Did you see what happened with New Gold recently and the gold mine they were trying to bring online?
Yeah.
Yeah, and that's why, New Gold had a good reputation for being mine builder, very solid mid-tier gold mining company, and then all of a sudden, even though the gold price is rebounding a little bit from late 2015 through most of 2016 and now, the costs of the mine have just gotten out of control. And now the mine's not really economic at current gold mining price because the cost went from, $800 million to $1.2 billion. So there goes their margin. It's basically gone. And since they've already sunk the money in for a penny, in for a pound, the stock prices collapsed. And, they had to fire sale a couple assets to get the mine going because they have to have the cash flow now, even though the mine's not cash flow positive.
Yeah, absolutely. I mean, just what I listed off as my sort of basic ingredients for what I want to see. That again, that's just for starters. I mean, the odds that a deposit is going to ever be developed into a mine, an actual mine, is very, very low. Probably less than 5% chance. So there's all kinds of risks that are inherent. Now, I will say that because of the takedown in the sector that occurred from 2011 until the end of 2015, and obviously it was mostly a manipulated takedown, a lot of these juniors, I believe, were driven down to levels that took them below the evaluation level, which was appropriate for the amount of risk involved with investing in these companies. So in other words, I think even now, the junior mining sector as a whole is extraordinarily good value relative to the amount of risk of losing your money in any one given situation. And that's why, if you're going to play in the junior mining sector, you need to own, at least 5 to 10 different stocks, maybe more, because most of them are going to end up being bagels, zeros. But the 1 or 2 or 3 that work out in a portfolio that has, I don't even want to say 5, I want to say 10 to 15 names. The returns that you'll get from the ones that work out will more than make up for what you lose on the other stocks.
Sprott also has a junior gold miners ETF. That's a basket of junior gold mining stocks, and the way they've done that, they've spent a lot of time and research putting together the basket, and the basket changes. So I think that's a way for diversification purposes for individuals who don't want to go buy your newsletter and do that. But I mean, there's so many things that can go wrong building a mine. There's over a dozen. You made up a point there about the risk reward for the junior miners in 2014, Dave, and for a good part of 2015, prior to the big move when the Federal Reserve did its first interest rate increase at the end of 2015. There were some junior mining stocks out there that were down 99%, over 90%, some of them 99%, and they were selling their market cap of the juniors. Some of these were selling for below the cash position that the company had in the treasury. So that's how negative and bearish the sentiment was for gold and silver prices. Harry Dent and these other guys were saying, gold was going below 700 down to 400. The usual suspects were coming out and just hopping on saying, silver's going back to $4. And so people were selling these things off and shorting them into oblivion. That was the time to, be stocking up and buying those things, because you were getting basically all the exploration upside, and you were getting a discount on the cash in the treasury for the juniors.
Right, and that's what, speaking of Sprott, that's what Eric Sprott's doing. He sees that the sector is extraordinarily cheap relative to the degree of risk involved. He's going out and he's investing his own money into a lot of stocks. That doesn't mean they're all going to work out, and I don't follow Eric Sprott. If he looks at a name, I'll take a look at it, but there's plenty of names he's looked at that I've turned down. But he's doing it because he wants to be invested, and he's got his own formula that he uses. He's got great connections, so he probably has an informational edge. But even when you talk to these mining company executives off record, the junior guys, even they'll admit, look, we don't, even if phase 1 and phase 2 drilling shows great results, that doesn't mean you're going to have something that's worth developing into a mine. I mean, it's a long, arduous process, and it takes many years to go from an exploration property into a developed producing mine.
Oh yeah. There's so many things that can go wrong with the pre-feasibility study, the metallurgy, the feasibility study. These things end up costing the mines 20-30% easily over what the feasibility studies are saying. So the people who are going by these estimates, there's a lot of things that can go wrong along the way. I've seen the cost estimates for a mine from one pre-feasibility to another one change 50%. For a manganese company junior years ago that was well promoted. So there's a lot that can go wrong in these things. But there, in 2014 and 15, there was the old Benjamin Graham net opportunities, where you would basically get a discount on the company's cash position, and you would get all the upside in the business for free, essentially. Those opportunities for Benjamin Graham nets are rare, since there's so many people looking for them, though.
Yeah, I agree.
Yeah, like you had that in 2008 with some stocks. You had that with 2008, during the brief period before, the Fed intervened and started reflating everything. There were stocks out there when there was total blood on the street, and you had that in gold and silver stocks in 2014 and most of 2015. Well, Dave, I enjoyed our talk today. If our listeners want to follow your work, how do they do so?
Just go to investmentresearchdynamics.com. I try to get a blog post out every day, but sometimes that's not always possible. And I don't really like to post things just to post them. So I like to think that when I do post something, it's value added. And I try to find things that aren't covered in the sort of the mainstream alternative media, like if Zero Hedge, I want to do something that Zero Hedge hasn't already posted on, or if they do post something and I think there's a better angle way to look at it, I'll post on that basis. So, and from that website, you can also learn more about my mining stock journal and my short sellers journal. There's links at the top. If you click on those, it's got a brief description, and the subscriptions don't have a minimum period of time, so it's not like some of these where it requires a big upfront payment and you're locked in for 3 to 6 months. And you can try it out and cancel at any time.
And for your gold fund, people have to be an accredited investor in order to join that?
Yes, that's correct. And that is it's a precious metals, physical bullion, and junior mining stock fund.
Okay, great. And also your Shadow of Truth podcast with Rory, you guys are doing a good job there.
Oh, thanks. I appreciate it. Of course, Google's trying to derail us all, aren't they?
Oh yeah, well don't get me started on how YouTube is sabotaging me. So our analytics across the board are 80%. I don't know if anyone else has been dinged that bad. I heard like SGT reports getting like 25% loss of their Google traffic, but we're down 80%.
Yeah, I've had a lot in the same period that you're down. I've had a loss of about between 25 and 30% of what they say is my traffic. I think they also changed the way they count it because they want to pay you less through their AdSense program.
That's a good point. One of our listeners to the program commented underneath that Google's underreporting views and downloads on YouTube so they can pocket more of the advertising revenue for themselves. Well, in either case, Dave, they're pocketing, they've stolen basically $70 to $100 from me and Mo, so they're a bunch of a-holes. Okay, well, that's it for today, guys. Mo and I are trying to raise $1,000 per month for our Patreon account. We have over 2,600 viewers per YouTube video, so if we can get most of our loyal listeners or all of our loyal listeners to donate $1 per month or up to $5 per month, which would be amazing, that would cover most, if not all, of the money that we need. So we also accept one-time donations if you go to the wallstreetformainstreet.com website. We accept donations in cash via PayPal. Fiat, you can donate there. You can donate Bitcoin through our Bitcoin wallet there on the website, or you can donate gold and silver. We have a gold money account, and we also accept mailed donations of physical gold and silver. Thank you guys for listening, and we appreciate any and all help. Please forward it to friends. Okay, bye.